critical level, as you talked about, in both the dollar and obviously the euro currency. What happens next? You know, we're at month lows in that euro currency, and we saw a little delayed reaction here today, whereas when the euro made a new low yesterday, we didn't see a new relative low in gold. It didn't take out that bottom. Now it's done so today. Let's see where we finish, but this is a very interesting point here that we've got to focus on. We had this big comeback climb in all assets over the last couple of weeks after that low in the stock market. That carried over. We had a big run up in crude. Crude got up to $64.25 a barrel, just $2 off the 3-year high. And we saw stocks come storming back. At one point, the S&P was 80 points away from its all-time high. The Dow was 800 points from its all-time high. And the NDX, the Tech 100, was only 20 points away from that all-time high. So we had a big bounce. Now let's see what happens.
Alan, let's talk more about the U.S. dollar, because that's really what I think is driving a lot of this. It seems like as some of the uncertainty with Brexit and the Eurozone kind of wanes, you're seeing the strength in the U.S. dollar. A lot of people had written off the dollar when it got down to 89. Now we're almost 91 on the dollar, and we seem to be hanging in there. Why do you think this has happened? Is this an uncertainty turning into certainty? What are you seeing there?
Well, as with any negotiation, there's always bumps. Just when you think you've got it done, there's usually something thrown in there to disrupt things a little bit. So that's where I think we're at. So I don't want to put that much into any one comment or commentary out of any of these guys. So we'll have to wait and see. But the path right now has been the dollar down. Now, I'm concerned, and I see a W pattern here, and that's W for worry. I'm worried that the bottom could be in the dollar, and I've been very negative the dollar here, but the price pattern right now, you could see that double bottom, and when we took out that low here recently, it's rallied since that time, and it didn't have any downward pressure. So the question is this different this time? I don't think so, but I'm going to focus on the price pattern. We did have a bounce in the dollar index, if you remember last fall, where it traded in a sideways range for a little bit and then resumed its overall downward decline. But as we've said many times before, and we both agree, it is all about the dollar. You saw when the dollar, strengthened here recently, that's what's hurt the stock market. That's what's hurt oil. That's what's hurt gold. So to see this asset reflation continue, we can't have the dollar strengthen at these levels. But my best but here is we had a weekly key reversal in the 10-year note last week. All right, that's big. We made new relative lows, and we had a higher close on a weekly basis in the 10-year prices in the futures markets. That could mean that the rate rise is over in the near term. So that could focus. Everybody's focus was on how the 10-year was moving higher, and the yield was at 2.95 or whatever it got up to, and so forth. And everybody was using that as a barometer that the game had changed. So if that stops now, then I think then we can resume our larger overall trends. And I'm looking for a squeeze to happen in that 10-year. Everybody is on one side of the 10-year. You know what happens when the markets have everybody on one side of the trade.
Yeah, it usually doesn't pan out very well for those that are on the heavy-weighted side. But hey, Alan, stick around for a minute, because we've got a lot to talk about here. I'd like to get your thoughts. But coming up, we're going to be talking about metals with a look at the latest levels in gold. That's next, right here on Futures with Lichtenstein and Hinks. With expectations. Welcome back, traders. I'd like to financial back to the show as well. We have Alan Nuckman joining us. I want to talk to you about what you're seeing in the Treasury's new lows yesterday in the 2-year and the 5-year. It's Treasury limbo, Alan. How low can they go?
Well, as you said, a lot of this is nonsense right now. The normal correlations and the normal relationships are not holding. So I have to look at things more on a weekly basis. The day-to-day relationships are completely out of whack. So that's where I'm trying to look at the big picture. Now, looking at the big picture, I want to bring this back out and look at the macro markets. And if you look at the macro markets, you look at the stock market, it had an amazing comeback. And so I would look at that as just a profit-taking plunge. We still have work to do, but if the S&P can get back up to those highs, a full V recovery, that targets 32.25 in the S&P, which is another 18% above. Now, before you say, whoa, that's too much, Every time in history the market has had a sell-off, it's bounced back the distance of that sell-off on top of the old highs. So I'm not going to be the guy that says this time it can't happen. Now, for that to happen, we probably need to see the dollar decline. If that happens, that helps out other asset classes, metals, energies, and those corresponding stocks that will help the overall market.
Alan, 2.837 right now in the 10-year yield. Pretty good, correction from where this was in terms of a rally in bonds and a correction in yields. So here's what I'm asking. Where are we in terms of what we're looking at for these numbers, right? We've got some numbers that just came out. We're looking at inflation, but frankly, some of the macroeconomic numbers are missing here as we go along the last 2 weeks to 10 days. So what are we looking at here is really, you see what happens when we get up above 2.9. Things get a little dicey and thick. We're not anywhere near that right now. So are we back down to a safe level in terms of yields?
Well, we can focus on every point in the 10-year. Really, that's really become the focus here in the last couple of weeks for whatever reason. Now, 3% up above. Let's keep an eye on 2.5% down below because that's the halfway point of this recent last leg that we've seen over the last year. So the midpoint is 2.75. So until we get down underneath 2.75, the trend is still higher right now in the 10-year. I thought there might be an attack on the 3.0 just to shake things up a little bit, but that hasn't happened yet. But again, that key reversal for me is significant. That key reversal also happened in the VIX a couple weeks ago. What happened to the VIX? Went straight down, and the VIX was below 15 at one time this week. Yes, it's bounced a little bit, but the VIX still is 60% off its recent highs. We had a key reversal in the S&P a couple weeks ago. Made that bottom, took off, and had a significant rally and almost got up to new all-time highs. So I'm trusting in what the charts are telling us right now, and until that's voided out, it looks like Treasuries may be having a path of lower yields right now and take a little bit of pressure off the markets and give us something else to focus on, like earnings.
Alan, I'm wondering if you think that some of the weakness that we're seeing in stocks as we come off at this point is the fear of rates spiking, or is it just that we're reaching that 3% level in the 10-year and we're starting to shift attention from stocks into the rates?
I would certainly not say it's not over. I would not say it's over in stocks. Yes, we had a huge surge off that bottom, and you saw the NDX, which led the way. The Tech 100 went up 12% in 12 sessions. Now that's a U-turn. If you look at Tech, it's still up 7% year to date. February net saw the S&P and the Dow lose 3, maybe 4%. That's not a big deal. That's a little bit of a pullback, and it had a healthy recovery. Yes, we saw some unwinding of that recovery here in the past couple of sessions, and yesterday was interesting because that last hour is when we gave back those gains and had a swing. But let's look big picture. We've made a significant recovery in the stock market, and it allows us to focus on what drives stocks. And you talked about a lot of these companies have earnings, and net, you've got 75% of the companies beating their EPS, 78% beating their revenue numbers. So it's all good in the neighborhood for stocks. Corporate America is doing fantastic, and I think we just had a little bit of a shot to confidence, which was to be expected after the straight up move that we've seen in the markets. But to get back to what we were talking about to start with, it's about the dollar and this W formation. Outlier months that might have a little bit more, bigger spike in inflation numbers, but we want these markets to reflate, is the word I like for. This is what we've been looking for, and this is what the Fed's been trying to stoke, is a little bit of inflation, and that's a positive.
Alan, weekly jobless claims just came out as well, 210,000. That is a low number. Now the 4 weekly average, 225 and change. So the labor market's doing its share to keep this economy strong. That is a number that personally I haven't seen in a long time, 210,000.
Yeah, the labor market's not been the problem. If you look at it, we've grown jobs on a monthly basis now for, 80 straight months. So that's not the issue right now. It's having the right skills to meet the labor's needs, to meet corporate needs. And so that's no longer an issue, I don't think. But we can use it as a bit of an indicator here. But right now, we like to make sure that more jobs are being created, and that's very much a positive. but I don't think it's that much of an indicator anymore. Now, we keep talking about stability, and as a trader, I probably feel less stable with political policy right now than I've felt in 20 years. So I know we always say the markets like stability, but let's talk about how the markets reacted. We haven't had political policy stability in the last year, and yes, the markets have extended that larger trend of going straight up since 2009, 2010.
All right, Alan, you've given a lot to focus on here today. I want to thank you for joining us this morning on Futures with
Thanks,
Lichtenstein
guys.
and Hinks. That's Alan Nuckman from Agora Financial.